Good evening and very warm welcome to everyone. Thank you for joining us today. I am Meena Rupani. On behalf of Trust Mutual Fund, I thank you all for joining us today for this insightful session on navigating volatility. Today, we have with us Mr. Mihir Vora, Chief Investment Officer. Mihir has over 3 decades of experience in investment management. In his previous stint as a Chief Investment Officer at Max Life Insurance, he used to manage 1.3 lakh crores of AUM. He has also held senior roles at notable financial institutes such as Aditya Birla Mutual Fund, HSBC Mutual Fund, I2 Mutual Fund, and SBI Mutual Fund. He is known for his high performing investment teams across mutual fund, sovereign wealth, and insurance companies. Along with him, we have Mr. Aakash Manghani, Fund Manager. Aakash has over 14 years of experience in areas of investments, equity, research, and portfolio management. In his previous stint as a fund manager at ICICI Prudential Life Insurance, he used to manage around 7,000 crores of AUM. His previous roles include the fund management at Boy Exam Mutual Fund and research roles at Girik Capital and PIMC. Mihir and Akash will run us through the presentation followed by Q&A. Would request participants to put their questions in the Q&A section. Without taking much of your time, would request Mihir sir to take it over. Over to you, sir. Thank you.
Good afternoon. Thank you, Meena. Welcome, everybody. Always a pleasure to be here. So I'd just like to spend a little bit of time giving a brief on the global economy and the local situation, including the market situation. And then, of course, we'll talk about the portfolio equities, etc. So it's been since we last met about a month ago. It's been an eventful month, a lot of action, never a dull day. Normally, there's never a dull day in the market, but this month was especially from the global point of view and even from the Indian economy point of view, particularly exciting and a lot of ups and downs. So we'll try to wrap up a little bit of that. So 2 or 3 things happened globally and locally. Globally, geopolitical uncertainty increased. So the volatility that you saw in the markets was not only due to financial issues, but also because of geopolitical issues. The chief of them, of course, is that the war in Russia and Ukraine continues, and there seems to be no end to it. That's one. More importantly, the tensions between Iran and Israel seem to be escalating, and we did see some serious amount of escalation happening. That continues to disrupt the Gulf of Yemen and those areas. And because of that, the shipping costs and the shipping lanes are disrupted, due to which ships have to go around the Cape of Good Hope around South Africa, almost doubling the freight costs, etc. So those logistic issues created by these geopolitical tensions continue. We also, of course, had the issue of Trump almost getting assassinated, and then suddenly his popularity went up and the probability of a Trump presidency increased. Then you had Biden stepping out and Kamala Harris coming in. So now the probability is now again matched. So a lot of fun happening in the US space with Trump, Biden, and Kamala Harris. And because of the very different, leanings of these, candidates, the markets also tended to react. The most important economy, of course, is the US, and there the growth data has been weakening a little bit. So while the economy continues to do okay, but the incremental data points are pointing towards a slowdown happening, probably even a minor recession. So there was a bit of a growth scare. Our backdrop has been that the global economy is doing very well, which still continues to be the case. But the situation is a little bit, I would say, more tentative than what it was 1 or 2 months ago. Because of that, the expectations globally of rate cuts have increased. The Federal Reserve tone was a little bit more dovish than expected. Bank of England cut rates. On the other hand, what has also happened is that because the US had kept rates very tight for almost 1.5 years, the other currencies were depreciating against the US dollar, especially the yen. So the yen actually weakened from almost 120 to a dollar to 160 to a dollar in almost 1.5 years. Now, for a country of Japan's size with an aging population, that means imported inflation. When the currency depreciates by almost 30-40% in 1 to 2 years, we saw that inflation in Japan, because imported goods, oil, etc., becomes expensive, inflation started to creep up and the currency continued to accelerate. What has happened is that till 130, 140, it was fine, but suddenly the yen in the last few months weakened almost to 160, and that was the breaking point. So Bank of Japan, which had kept a negative interest rate policy for almost 25-30 years, had no option but to react to stem the currency rout. Otherwise, it would have become like a Turkish lira or a third world currency. So they had to hike rates. They only hiked rates by 0.5%. But last week, that created big havoc in the global markets. And the key reason is because yen is one of the weaker currencies with zero interest rates, which means that global fund managers and speculators and hedge funds use yen as a funding currency. So because it's a weak currency with low interest rates, it means you can almost borrow at zero negative cost of borrowing in yen and then put money into all other asset classes in the world. So this borrow mechanism and the investing elsewhere into, say, US bonds or US equities or global equities, including India, is a big trade. And because it's free money, right? You borrow cheap, and you invest in other risk assets. So everything, equities, bonds, Bitcoin, etc., has this element of borrowing in yen. This is called the yen carry trade. So this yen carry trade actually accelerated after the US started increasing rates in 2022, 2023, because the US rates started increasing. So the dollar was strong, the yen was at zero interest rate, and it was weakening. So it was very easy to borrow in yen and invest in dollar assets. So this carry trade became like a rubber band and kept on increasing. It became a very, very stretched rubber band. And as I said, when the yen touched 160 and Japan inflation started to spike, it was the breaking point of the rubber band. And you saw the Bank of Japan increase rates just by 0.25%, and all hell broke loose because huge amount of leverage was there in the system. So we saw Japanese markets, US markets, global markets fall by 5, 6, 7, 8%. Japan has fallen by almost 20-25% in a matter of 2 months, the stock markets. So there was a lot of volatility around that. Of course, India does not have that much of speculative investors as it is in the last few quarters. We haven't really seen huge inflows from FI. So the element of speculative money coming into India, both equities and bonds, is minuscule. So I was not too worried. But when the whole world is falling, India can't be isolated. So we also saw volatility in the Indian markets. So to that extent, I think there was a bit of a hiccup in the last couple of weeks, volatility because of the global macroeconomic situation. So as we stand, Bank of England has made some conciliatory noises that, oh, we won't hike if the markets are volatile, just to try to soothe and calm down the market. So things are kind of coming back to normal slowly. I would not say the whole problem is gone away, because again, if they don't hike rates and the yen continues on its depreciation path, then again they'll have to do something about it. So the situation is volatile. The situation is kind of evolving, but probably that big cut that we saw, big volatility that we saw, is past us. So that's on the global situation. So as we stand, there are chances that the US economy will continue to slow down, may not go into a big recession. But the fact that we are slowing down, the US is slowing down, means that the Federal Reserve will continue to adopt a more dovish tone, and we will see interest rate cuts happening in the US in the next few quarters. So as of now, the view is that interest rates will start coming down in the US, and of course in the rest of the world, as I said, typically tends to follow the US. So we are in for a little bit of slowdown globally with interest rates coming down, which may not be a bad thing for India because Indian economy continues to grow well. We had the RBI Monetary Policy Committee meeting yesterday. The tone was tentative, I would say. They are still cautious about all this global volatility. So they were a little bit hawkish and trying to keep the currency stable. If you talk about cutting rates too fast, then maybe the currency can weaken. So the RBI is saying that we'll continue to watch. We won't be very dovish. But things are overall under control and Indian growth story is okay. So when the growth story is okay, you don't really need to cut rates aggressively. So we will see rate cuts in India, probably with a little bit of lag after the US rate cuts happen. Otherwise, I think as far as fiscal and monetary is concerned, we are in fine fettle. We also saw the union budget being presented by the finance minister. It was I would say, pragmatic budget, of course, with a little bit of hiccups on the capital gains front, and hopefully, but they are trying to address that too. But overall, I would say that the budget was pragmatic, fiscal discipline. They brought down the potential deficit by 20 basis points to below 5%, hopefully in the next couple of years. So to that extent, I think it's a confident building measure. And I think they will continue to be conservative on the fiscal front, on the budget front, because as we have discussed in the past, India is going to get included in the global bond market. It's already gotten included in the global bond markets. So fixed income flows from foreigners are likely to accelerate. They've already started coming in. But those flows are very, very conscious about macroeconomic stability. So I think the fiscal discipline, inflation control that we are showing is a good thing. I think the finance minister and the overall government will continue to project India as a responsible country with very good macroeconomic stability. So I think currency is stable. The fiscal situation is under control. Interest rates are under control. So Indian growth story, I think, to that extent is intact. In the Monetary Policy Committee, as I said, the tone was a little bit hawkish, not too much, but a little bit hawkish. They did mention that they are conscious about inflation, so they will continue to watch that, and based on that, the policy will evolve. But I think inflation fighting as a key objective continues to be one of the priorities. So I think that was on the domestic front. We had corporate results coming in for the June quarter. It's been a mixed bag. Pockets of good, pockets of not so great, but overall, I think maybe 1% cut in earnings, nothing to kind of really mention. But I think the overall macro picture of about 15% earnings growth for the next few years, couple of years at least, seems to be on track, and our style of growth investing continues to kind of be relevant at this point in time. So that was a little bit of wrap up on the global economy and the domestic economy. Now coming to the equity markets, what has happened is that, as I said, results have been mixed bag, and we are now hoping that with the monsoons progressing normally, we should see some amount of revival in the consumption space. In terms of market movements, what has happened in the last 3-4 months, especially in the last couple of months, is that we saw a lot of excitement and a lot of activity in NFOs. And most of these NFOs were concentrated around some of the themes which we already liked. So if you remember, we were quite overweight on some of the themes like the physical asset themes like capital goods, construction, real estate, etc. But many of the funds came into these segments only. So there was defense funds, there was manufacturing funds, etc. So there was a bit of I would say, excessive frenzy in the last couple of months. And when a fund gets launched, of course, they want to deploy it in 5 days, 10 days. So many of the stocks and sectors that we already liked and which were there in the portfolio actually ran up quite a lot. So while we are not really looking to trade actively in terms of trading, but as I said, when you had a big chunk of money chasing these manufacturing and defense stocks, valuations, stock prices really ran up very sharply in some of these cases. Valuations may be overshot for the time being. So what we did was we kind of booked profits in many of the segments and stocks that we liked. And of course, we deployed it. So broadly speaking, as you know, in capital goods, we had almost a 20% weight. We brought it down to close to 11%, 12%. We also decreased weight in some of the durable stocks because again, automobile, not consumer durables, discretionary, I would say, not durables, discretionary stocks, because auto also part of the manufacturing theme, and some of the auto stocks, when the manufacturing funds came in and bought, they went up quite a lot. So we booked profits at better levels there also. So we reduced almost 3% in automobiles. So big ones was basically capital goods, significant reduction, automobiles, significant reduction. And then, because obviously we need to deploy cash, and some of the pharmaceutical companies started to give good results. Some of the chemical companies started to give good results. So we increased exposure in those segments. So we increased exposure to healthcare. We increased exposure to some of the IT stocks, especially the mid-cap IT and some of the stocks which get classified as IT but are actually in the space like like data centers, etc., not IT services per se. So we kind of added exposure to those segments. We also added exposure to some of the power segments, which we continue to like. So that's broadly the broad move that we've done. FMCG, we increased a little bit, a couple of names that we liked. So as I said, we booked profits in some of the frenzied counters, and we kind of shifted weight to segments where we thought that the growth at reasonable valuations equation is a little bit better. So I think we're not taking a big cash call. We continue to follow our philosophy of growth at reasonable valuations, especially with in stocks that are likely to have large or huge terminal value upsides. So that philosophy continues. So to that extent, as you know, we have discussed that our portfolio tends to be a little optically higher in PE compared to the benchmark. That continues to be the case. So our portfolio PE on a forward-looking basis is about 27, whereas the benchmark on a forward-looking basis would be closer to 23. But the peg of our portfolio is closer to 1.5 compared to the peg of the benchmark, which is closer to 2.5. So I think we have higher growth stocks in the portfolio, where we believe that the current PE may look high because these stocks have higher longer term growth prospects, higher longer term terminal value. So we continue to kind of stick to that investment philosophy. So with that, that kind of was a little bit of short and sweet of the global markets, the Indian markets, our equity portfolios. And Akash is here, of course. Akash, do you want to add anything on the portfolio, etc.?
Yeah, hi, good evening to everyone. So Mihir has actually covered it quite well. So, like you said, we've cut down a bit of exposure to some of the high-flying names in cap goods, defense specifically. I would like to highlight. We had about at the peak close to 8.5% exposure to defense. So this theme actually was already quite hot over the last, I would say, year or two. And in the last 3-4 months, specifically after our NFO, I think a lot of the stocks, there were stocks in our portfolio which are up like 50-60% in a span of 3 months. So we took a prudent call that I think a lot was getting priced in. Not only the next 2-3 years, but I think the next 7-8 years of growth in some cases possibly could have got priced in. And also there was a slight dampener in the budget where a lot of the market participants started to believe that this budget would be having much higher allocation as compared to the interim budget towards sectors like defense, railways, roads, things like that. But however, this budget allocation was very similar to what the interim budget allocated. So there was just about a single digit year-on-year growth in allocation towards some of these sectors. Although the overall capex growth in the country, made by the central government, is in double digits, but some of these sectors which were the high flying sector of the market. So we thought that it's best to sort of take some money off the table right now. We continue to find very good opportunities. So although sectors like, headline indices around mid and small caps are seemingly expensive, but interestingly, a lot of the opportunities that on a week-on-week basis we keep discussing are mostly around mid and small cap sectors. Specifically, sectors like pharma are coming up where we are getting to see broad-based growth across most pharma companies. We're getting to see anything between 15% to 30% profit growth, and that too has been sustaining for the last couple of quarters for a lot of companies. So that sector looks quite interesting at this juncture. We believe that with the interest rate cut quite certain now in the US, discretionary spending across a couple of sectors could come back specifically in the US market. So some of the IT companies that we added exposure to have disproportionate share in discretionary kind of work that happens in the US, where you're moving things onto a cloud or revamping the existing system or doing data analytics, things like that. So I think they should benefit, maybe not immediately, but 2-3 quarters down the line, specifically after the election is over, clarity would emerge, and calendar year 2025 could be a much better year as compared to calendar year 2024 for some of the discretionary mid-cap IT companies. So yeah, I think I'll leave it there, and we could get into Q&A.
I can see some questions in the chat box. What
Yes,
is the
sir, they are
next?
coming. You want me to
Yes,
read it?
yeah,
Okay,
I'll
sure.
try. I'll do that. No problems. One question is, what is the next quarter view on the Chinese economy? Is there any early signs of China to come to limelight with GDP development? Second is the yen carry trade over, or is it only a trailer? Good questions. So I think China continues to display weakness. In fact, in some of the segments like steel, etc., we've seen more dumping happening from China, which means that the local demand is just not there in China. So Chinese economy continues to, I think, stutter, not doing that great. The government is trying everything to kickstart consumption. They are trying to make sure that people spend more, but that culture is not changing. They're still dependent on manufacturing and infrastructure and real estate to drive GDP growth. But that bullet has been used too many times, and that's not becoming effective anymore. So China has too much infrastructure, too many factories, too much manufacturing, and too less consumption. But that's not changing because I think it's a structural issue. It's a cultural issue probably. So I think the Chinese economy will continue to grow at about 4 to 5%. It can't. I don't think it's going to grow at 6 to 8% like it was in the past. So relatively speaking, Indian growth will continue to be better. But as I said, the threat is that because if China remains weak, then the threat is that they'll continue to dump material on the world, whether it's chemicals or steel or even EVs, electric vehicles. China is like crazily gaining market share across the world in electric vehicles. So that I think pressure from China globally will remain because of Chinese weakness. The second question is the yen carry trade over or is it only a trailer? Uh, by some indications, a lot of the carry trade would have been unwound in the last few days. But the point is that it's such a large, systemic trade that I don't think things like these get over in a couple of days. So on one hand, you'll have a situation where the inflation in Japan has to come down. So I don't think it's time that the Japanese bank will say that yeah we are done fighting inflation and inflation is coming down. So they'll also have to keep a close eye on that. As I said, this is the interest rate differential between the US and Japan is like 5%. So the carry trade can still continue even if the Bank of Japan hikes it by 0.25. I think it's the direction that scared people. So if the Japanese interest rates keep on going up, so we can see some more volatility. The good thing is that the US is now on a cutting spree. So the differential will slowly come down as the US cuts. So in September, people are expecting the Fed to cut rates by 50 basis points, which means that Bank of Japan is hiked by 0.25, US will cut by 0.5. So that differential will come down. So the relative incremental carry trade will be less attractive. But existing trades, I don't think they would have been wound down completely. By some calculations, all the profits that these carry trades have made in the last 12 months are wiped out because of the market volatility recently. So there are big funds out there, big investors out there who would have suffered substantial losses. So we really need to see in the next couple of weeks how things go. So I think, yeah, you can see some more volatility on both sides. Yen, as I said, yen went from 120 to 160, and in like 4 days, it went from 160 to almost 142, and now it's back to 147. So it's huge volatility, almost more volatile than stocks actually, the currency. So I think this will probably create some more bouts of anxiety in the next few months. So that was the other question. There's one more question on specialty chemicals. Is the turnaround story just started? What's the view on specialty chemicals and textile business? Any insights, Akash, on specialty chemicals?
Yeah, so the question is, I think, has the story just started, or what's your view on specialty? So this sector, interestingly, was a massive wealth creator between 2014 to 2020, and multiple multi-baggers got created. Actually, this was a harbinger of the entire China plus one or Make in India theme at that juncture. So you got to see companies going up 10x, 15x, 20x in that time frame. In the last 3 years, I think what has happened is that a lot of the relocation that was happening in that benefited these companies because China was moving out of polluting sectors and relocating a lot of their factories between 2015 to 20. All of that relocation has happened. And now China is back meaningfully in a lot of the chemicals. So there's a very thin line of difference between specialty chemicals and maybe base chemicals. So I would say that one needs to be very, there is not synchronous movement across companies where you can say that things are back because a lot of these companies sort of export to Europe or export to US and things are I would say pretty patchy. So you have to be stock specific. We are getting to see early signs of green shoot in some companies. So I cannot say for a fact that the entire sector is back. So it needs to be very stock specific.
Thanks, Akash. Sir, we have further questions. Do you want me to take it for you, sir?
I'll take it.
Sure.
With the US, the question is on US. With the US planning to reduce interest rates, does it mean that the US economy is slowing down and hence demand collapsing? How will it impact our markets? Good question. As I think I briefly mentioned that the US is slowing down, likely to slow down. But so far, it does not look like it will fall into a recession or very sharply go into a downturn. I think the over exuberance and the overspending that the US consumer did post COVID was because of massive fiscal incentives that the government gave and continued to give even in 2023 when it was not required. So I think that party is over and you will see US consumer spending slow down. But whether it will take the economy into a recession is a question mark. We are not building in a sharp recession going forward. It may impact demand a little bit, but as long as it's a controlled and a measured slowdown, it becomes a good Goldilocks situation where we have gradually falling interest rates, which is good for risk assets, which means that FI money, etc., can flow to other asset classes. Typically, what we've seen is that in a benign interest rate environment, people tend to take more risk, so money flows into riskier assets like emerging markets. So the foreign money should come to Indian markets, both equities and bonds. So in that situation is a good situation where we have a US slowdown, but not a very sharp one. So right now it looks like we are in that kind of situation where we are really growing very well versus the rest of the world. RBI in the monetary policy also mentioned about 7% growth rate for India. So India growing at 7%, rest of the world growing at 3% or so. India becomes really attractive, and we should, in terms of impact on our markets, as long as there is no major disruption like we saw during the yen in the last 10 days, I think it should be fine for India. Other question is, do equity market do well in a rising interest rates or falling interest rates? Well, it really depends on the situation. If rising interest rates are happening because growth is too strong, then equity markets continue to do well. But if interest rates are rising because there is an inflation scare, then probably it's not that great for equity. So it's really in what context interest rates are rising or falling that determines the market behavior. So in a normal circumstances, we have seen that interest rates rising actually is good for equities because that means that the economy is doing well and the central bank is cooling off the economy because it's too strong, which is fine. So that's the normal situation for you. Is the P peg of 1.5 for years or 5 years? What is the PE for FY26? These are all numbers for the next 1 to 2 years, I would say. Will the top 10 stocks weightage increase or remain similar range? And we would see 55 to 60 stocks in the portfolio. Yes, I think we will continue to see 55 to 60 stocks in the portfolio. It will be a focused portfolio. And to put things in perspective, the benchmark is NSE 500, which means there are 500 stocks in the benchmark. And from that, we are bringing down the portfolio to about 50 to 60 stocks. So that's been the stance from the beginning, and we continue to stick to that stance, I would say. I'll try to share the portfolio details, but in the meantime, if there are any other questions, please go ahead.
So there's another question. Will the rate cut by Fed help India to boost equity markets, keeping globally volatility in view? Maybe Aakash, if you want to address that question.
Like Mihir just answered, right? I mean, it's dependent on how shallow, how deep the US recession is. As of now, the view is that US recession, if at all, will be quite shallow. There isn't a very strong view that US will go into, a very deep recession. Most of the companies, the corporate earnings growth in the US was quite decent, actually. I think single-digit earnings growth out of the US market, and most of the earnings that they delivered this quarter and even the last quarter was better than estimates. So interestingly, US is having many more earnings beats than misses as compared to India. And I think the economic environment is not that as bad as it is made out to be in the US. Uh, so is it good or bad for Indian equity markets? In the short term, if you look at the data of going back the last 25, 30 years, markets have more or less rallied after the first rate cut. So if you look at market performance 3 months, 6 months after the first rate cut that happened in the US, market returns have been positive each time for the last 30 years. So, and after that, the markets become more data dependent upon how the corporate earnings are, things like that. So, yeah.
So yeah, so this is how the portfolio looks like in terms of concentration and mid and small cap. Broadly, the large cap, small cap, mid cap mix remains the same in spite of the fact that, as I discussed, we did significant sector changes, but the large, mid, small exposure more or less remains the same. It's about half and half, half large, half mid and small. Top 10 stocks is about 26%. Largest stocks is 4%. Top three industries is 32%, which was actually a little more last time. The top five mid caps, small caps are all here. Some more or less same similar names. Some stocks have gone up or down depending on the weight. And we have 60 stocks exactly in the portfolio as of July end. So that broadly, we're continuing with the same style over the last since we started. It's not been a very long history, but the delivery has been as promised in the NFO, which is running a good mix of mid and small, a tight portfolio, and and actively managed. So I think we are following up on all those counts.
Thank you, Mihir. So we have a question asking any view on banking and financial sector as it has not done better for a long time.
Yeah, so I think banking and financial is one of the most important sectors, and if the market has to do well, BFSI has to do well. Right now, we are in a situation that valuations are very attractive. Asset quality is very good, both for banks as well as for NBFCs. The only thing that is preventing faster growth is basically the tightness that the RBI has kept in the liquidity situation. And the RBI is also trying to be a little ahead of the curve by forcing banks to cut back on the retail lending, the unsecured lending. So I think while balance sheets are clean, valuations are very attractive, but because of these liquidity, higher interest rates, tighter liquidity, higher interest rates situation, we are seeing that credit growth is not happening at the rate it was. I mean, given a choice, bank would continue to grow their unsecured and retail credit book very rapidly. But RBI is saying, no, we are watching you. You are not supposed to take risks beyond a point. So please cut down. And so we have seen a sharp reduction in the growth of unsecured book. Now, the thing is that the unsecured retail book happens to be the most profitable. We are talking about loans at 13, 14, 15, 16% or so. So that is temporarily impacting the profitability of banks. So we did see some margin squeeze, partly because of cost of deposits because of the tightness, and partly because the high yield segment of retail deposits has slowed down. But I think it's a temporary situation. While we are underweight on banks and NBFCs, we are just looking for the right time to enter. In terms of quality, in terms of potential, in terms of valuations, we are absolutely comfortable. We're just looking for the right time to make sure that we increase exposure, and at some point in time, we will go overweight on banks and NBFCs for sure. In the meantime, what we are doing is that we are seeing better opportunity in financials in the non-lenders. So lenders are banks and NBFCs. Non-lenders are a host of other segments like asset management, broking, wealth management, insurance. Well, I think I already mentioned wealth management. So these segments, which are capital markets linked, which are savings linked, which are insurance linked, both life and general, these are the segments which are continuing to grow very well. So the broad theme of financialization continues. It's just a question of lenders versus non-lenders. At this point in time, non-lenders are doing better. So we find opportunities there. But overall, I think the space is a good space to be in.
Great, sir. So there's another question asking what view on IT sector in lieu of more use and development of AI.
So AI is an opportunity and a problem. I think long term it will be a problem. In the short term, it may be an opportunity as a lot of companies are investing a lot to process AI for data tagging, etc. And AI also needs a lot of computing power. So you have opportunities coming up, for example, in data centers, etc. So I think new opportunities will come up, new business models will come up because of AI. In the long term, probably Indian IT services may get impacted as a lot of tasks start getting automated. So I think it's a question of long term versus short term.
I think you've already answered. Someone wants to know the FlexiCap portfolio composition going forward. I think we've already answered, I think, this question, so we can skip.
Suffice it
You want to
to
add
say,
something on this?
no,
Yeah.
I think I'll just reiterate what we reiterate every time, that we will be agnostic of sector. We will be agnostic of large, mid, or small caps, and we'll be agnostic of everything. We will just make sure that we follow the core philosophy, which is growth at reasonable valuations with terminal value as our North Star. So I think that will continue, whichever stock or whichever sector we pick in.
Great, sir. Valuations of Indian markets post the market crash.
अरे मार्केट क्रैश कहाँ हुआ है यार अभी तो which what crash are we talking about? Next question.
If an aggressive investor is investing lump sum with a 3-year horizon, which 3 schemes would you recommend from your AMC? But we, as of now, only have the one fund, which is our TRUSTMF FlexiCap fund. So, would recommend to invest in our TRUSTMF FlexiCap fund.
Because it has large cap, mid cap, small cap, everything.
Small cap, all three in it. Yeah. There was also a question when TRUSTMF will become in thematic like technology and manufacturing funds.
I just said we sold everything to the technology and manufacturing funds, to the manufacturing defense funds. So I think it's not a question of not liking those sectors. We are very positive on manufacturing. We are very positive on defense, railway, all those themes. It's just a question of valuations becoming, overshot, going overshot for a short period of time. As a young fund, as I said, we only have one fund, one equity fund, which is only 3 months old. But we will be in all sorts of funds. Preference would be to build the basic funds first, like your mid cap fund, your small cap fund, your balance advantage fund, even large cap. So I think get the basic staple right. And then, of course, we can go for more fancy stuff.
And the next question is what's the monthly turnover ratio of the fund?
Off the hat, probably about 20 to 30% on a monthly basis.
Thank you, sir. And the last question is any new NFO in the coming period?
That is for Ajay to say.
Ajay, sir, would you like?
Yeah, so we have got an approval for the small cap fund. So, and also we'll be filing few more funds, but we expect a small cap to be launched very soon.
I would request participants, if you have any more questions, would request you to put them in the Q&A session.
Meena, if there is no further question, we can.
Sure, sir. Someone has asked for the fact sheet, sir. We will share this fact sheet with you on your mail ID or soon, sir. Thank you, everyone. Thank you for joining us today for this insightful session. I thank all of you on behalf of Trust Mutual Fund. Look forward to your participation. Thank you.
And just
Thank
a
you.
reminder to all the participants that typically we will have our monthly call every month on the 9th or 10th. So in case you have not got an invite, you can just check with our RMs. But 9th or 10th typically will be a date from the Trust AMC. Thank you.
Thank you. Thank you.